talk a little bit about liquidity. And again, one of the reasons why Granite is such a core holding in our funds, because you've managed your balance sheet properly and you've got plenty of liquidity that, as you say, helps you through more challenging periods, more importantly, but also gives you the dry powder to take advantage of opportunities, whether that would be development and or acquisitions. And looks like maybe you've taken your foot off the gas there a little bit, like your competitors have. What are your thoughts there in terms of that growth strategy through acquisition and or development?
Yeah, I think we still talk about liquidity in our calls. And I think it's interesting to me in talking to a number of investors, even at the beginning of this year, the feeling was, well, when are you going to resume acquisitions? And there's two things I would say about that. I still think we're in a position where liquidity is our highest priority for us. And I'm not being doomsday. But I don't feel any imminent danger with our sector at all. We're fortunate to be in the sector that we are. But I think that there will be opportunities. We just have not seen, I think, a level of distress in the market that's commensurate with a lot of this overweight, over sort of lending that's going on, particularly in private equity.
Do you think that distress is something we will see at some point here, giving you some opportunities? Yeah.
We do. And so we're in, a fortunate position for a lot of reasons. Some we've created, some we haven't. But we are retaining roughly $7 million a month in cash after CapEx, after maintenance CapEx. So our AFFO payout ratio is in the low 70s, that's intentional. And that's working out well for us. And so, we're using that to fund our active development pipeline, which we're going to shut down after this year and wait for opportunities. And so one of the things that I do think is when I look at potential areas of distress is a lot of these smaller developers, particularly in the US, but Europe as well, will be in way over their head in terms of the land costs, and the construction costs keep going up. So your economic rents are very high. We had a situation in Nashville where we have a really well-located development site with 3 buildings, which we're working through the leasing on. And down the road, I would say close but not in a strong position as us, is a developer that's looking for a capital partner at rents that are 25%, 30% above our asking rents today, because that's what they need to make the pro forma work.
Are they going to get those rates?
They're not going to get those rates. I don't think that they're going to get those rates, and I don't think they're going to find the capital. So at some point, the lender or someone is going to get involved, and I think that will create some buying opportunities for us when the time is right and when we feel comfortable with our liquidity. And I will tell you, we're not comfortable borrowing to acquire at this point in time. We're very happy with our balance sheet. And so not only do we need to see interesting opportunities, but we need to see market conditions and cost of capital make sense to us to move forward.